Good morning, everybody. This is Brian with Financial Brokerage, and this is the 13 strategies to help your clients pay for life insurance-based long-term care webinar. I want to thank all of you for joining us here today and taking time out of learn some ideas that can help you with that business moving forward here on out. For those of you who are not, we are a national marketing organization working with financial advisors and insurance in the areas of life insurance, long-term care, disability insurance, and critical illness insurance. I'm one of our life insurance specialists and have been here nearly 20 years at this point in time, and about 25 years. And as I can see, who's have worked with many of you, so I appreciate your time here this morning. Last more than 20, 30 minutes or so, and it comes to us at Lincoln Financial Group putting this together. Lincoln has put together a very comprehensive presentation, and we're just going to cover a small piece of that in the middle. We're going to get right into the meat of the sales ideas. If you have any questions throughout the webinar, all of your lines are muted. We do that to cut down on the background noise, but you can still type them in the questions section on your computer screen, and I'll get to as many of those at the end of the webinar as time allows. So this webinar is going to focus really on ways that you can design life insurance care policies to match the different situations that you're going to come across with your clients. And these 13 strategies primarily focus on different ways that clients can pay the premiums for these, and maybe in a couple of cases how they can just pay for care outright. A lot of times we overlook some really unique situations. Clients certainly would never think of these, and a lot of times as advisors, you just forget things from time to time. So we're going to cover some of these really unique policy design strategies. And bear with me for a few seconds here. I'm going to get to where the sales ideas really are in this presentation. But on our way there, this is what I want to make sure that all of you see. Lincoln has put together with live links with all 13 strategies. You can see those there in the middle. And for everybody who attends, I'm going to make sure that you are emailed a copy of this PDF from Lincoln. Each one of those 13 strategies you see there in the middle, if you click on that, it's going to take you an explanation of how that works, and then also a illustration that they've put together, along with some special pages in the illustration that really outlines that particular strategy. So you can dive really deep into each and every one of these. I'm going to give you my take on how these strategies work as we walk through them here. But that's going to be coming later on to all of you who are listening. And going into this, assuming that you're already aware that long-term care is expensive, it's needed for most of the population at some point in their lives. And as advisors, we're in a position where we can help people plan for this, have to exhaust all. And people like to purchase traditional long-term care, but found over the past several years, people really gravitate towards life insurance-based solutions. So how do we help them pay for these? Well, here's the 13 strategies that Lincoln Financial put together for us. And I'm going to start with what they call the 50-10 hedge. And this is a sales strategy you can use when you get a cost objection from your client. Client says, I can't afford it. It's outside of our budget. I guess we're just not going to do anything. We're going to not be covered. Well, look, there's nobody out there that says you have to cover the entire cost of long-term care. People are very familiar with the concept of deductibles. They have out-of-pocket deductibles on their auto and homeowners insurance, on their health insurance. There's always something that they're going to know that they're going to be paying out of pocket. It's not offered from day one. So why don't we treat long-term care the same way? So with this idea, what we're going to do, instead of planning to cover the entire cost of care, we're going to plan to cover 50% of the client's nursing home expenses and assume that they're going to pay the other half of that out of pocket. Now, it just so happens that roughly 50% of nursing home expenses are about the same cost as 100% costs anywhere in the country. Now, since home health care is where most people receive care anyway, certainly in the beginning, you'll have everything covered right away. And no matter how many years you plan for this, if it's 1 year, 4 years, just cut the nursing home allocation in half, and now you've got 100% of the home health care covered. Now, the 10 in this strategy title refers to the client will be paying premiums over 10 years, so they don't have to worry about that obligation any further than that and continuing to have to pay premiums as they continue to age. Done in 10 years, they've got 50% of nursing home costs covered, and this can help you when the client says, I just can't afford that. So this is a strategy to get some sort of coverage. Okay, the multi-generational play. Now, this idea is really two ideas in one. And in both scenarios, the insured and the payer are people. So scenario goes like this. If you've got older clients who may or may not be insured, they could still provide funding for policies on their adult children. This works particularly well if they're already looking to pass on a legacy, pass on not going to need while they're saving. Why not funnel those funds into long-term care policies that their adult children have to purchase anyway? Maybe the adult children don't necessarily have the funds to pay for that at this point in time. So that's one way you could look at this. If you run across some clients that you think would be good candidates, but they're not insurable, you haven't lost a sale completely, ask them about their adult children. Now, you could also flip this idea around too. So maybe the adult children are doing very well financially, but mom and dad, they're insurable, but they don't necessarily have the cash flow to purchase a policy. And this is an idea I've actually out there where asking about the adult children, or you've brought it up with those adult children, and just positioning it so that they were the ones who paid the premiums for policies on mom and dad. And it's really in their financial interest to do so, because if mom and dads have to spend down all of their assets and go on Medicaid, those adult children are inheriting absolutely nothing. So they have an opportunity to protect their inheritance, have to worry about becoming caregivers for mom and dad. I mean, that's usually the first thing that happens right there. Well, now if policy in place, they can hire home health care agents in, and they don't have to worry about the quality of care. They don't have to worry about who's paying for the care for their parents. All right, so a similar idea, multi-generational play, and really kind of hinted at that with that previous idea, involves gifting strategies. It comes into play if you've got some clients that may be looking at federal or, if not federal, only estate tax problems. In the few states that have estate tax, the threshold is much, much lower than it is at the federal level. So in those instances, you want to bring this up. Your clients, can gift up to the limit of, I think it's about $15,000 per year this year to their descendants. A couple could give double that, but they would be gifting that money, assumption that the money goes into a life insurance-based long-term care plan. Now, this is going to do a couple things. It's going to reduce their estate, so there's less taxable estate when they pass away, but it's also going to protect the assets of future generations, because now those adult children are covered for long-term care. And of the gifters don't have. Another idea that I know I've brought up in some planning situations before, using an annuity to fund a person's long-term care plan. I know a lot of you do business with annuities and know which clients have them and which clients you would like to have them. But if you're looking at your annuity book of business, don't forget to look at those as potential funding vehicles for a life insurance-based plan. Maybe these funds are sitting around and are what you might refer to as lazy money, funds that the client is never going to tap into anyway. It's earmarked for the next generation. Or maybe they're already taking an income stream from the annuity, maybe because they have to, if it's already planned this out as part of their retirement income. Well, the nice thing about the stream is, oftentimes it's guaranteed to remain. This can become a very predictable source of regular income for the client to fund the policy. I know a lot of you in the past have converted funds into SPIAs, single premium immediate annuities, and then turned right around and used that income stream to pay for a policy. So there's several ways you could utilize annuity money to become the funding vehicle. Now, closely related to that, and you're going to find a lot of these ideas relate very closely from one to another. We just get into a few more specifics. When you're reviewing annuities or even their qualified funds, look at their if they're already there, or look at what those RMDs will be when they get to that age where they're going to be required to take those. So some people take their RMDs not because they need to, but because they have to. So, as I mentioned with that last idea, why not use that stream of income as the for a policy? Now it's going to protect the rest of their assets. Closely related to this same idea, some people don't realize that you can actually utilize qualified money to pay for one of these products. Now we know, with the discussion on RMDs, that tax qualified money has to be distributed at some point. Well, here's a little, why not take that money as soon as you can? Don't necessarily wait for the age where you have to take the RMDs, but why not use those distributions at 59 and a half? Now, yes, you do have to pay taxes on that money, but you have to pay taxes at some point anyway. So, depending on where the tax rates are at a given time, a client might want to start taking that taxable money sooner rather than later. We know the tax rates are going to go up in 2025, 2026 when the current law expires. It might make a lot of sense to take advantage of today's lower rates. You still can, rather than wait for the rates to go up in a few years. Now, if clients a income tax increase in the future, whether it's due to the law naturally changing or maybe a new law that could be passed by Congress, it makes a lot of sense to purchase a 5-pay or a 10-pay or maybe even a single-pay product to use those tax qualified dollars while the tax rates are pretty low. All right, a little idea in the Secure Act, and for those of you who have seen some of my webinars earlier this year, I've done an entire webinar on the tax changes involved with the Secure Act and how you can help your clients cope with that. And one of the items in this huge law that went into effect back in January was that it changed the rules regarding what was called a stretch IRA. So it used to be the fact that heirs could stretch out in IRA distributions over their lifetimes. Now, that's not the case anymore. Now, inherited qualified funds must be taken, taxes paid by the end of the 10th year after the death of the original owner. So this means in a lot of cases, adult children in their peak income earning years are now going to have additional taxable money that they have to pay taxes on, in their highest tax bracket they've ever been in, and now they're getting more taxable money maybe boosting them into yet another another tax bracket. So you have to look at the client's situations, but it may make sense in a lot of cases for current IRA owners to use those funds today, pay the taxes today, and use that money to fund one of the hybrid life-based LTC plans. The tax bracket of the current owners could very well be much less than their adult children's tax brackets will be in the future. So we need to look at the client's entire picture, the tax status of not only themselves but also of their heirs. Finally, getting out of the ideas that revolve around qualified money and taxes, and now getting into another one of the common objections. A lot of times we'll run illustrations for folks, and then the feedback that I end up getting back was that the client decided that what, they have enough money. They looked at the insurance proposal, but they're going to fund. They're going to pay out of pocket. Well, when you have clients who object to purchasing a policy because they believe that they're going to self-fund this need, go ahead and play along with them. Play along with this, right? Show them exactly what that's going to look like in the future. Now, luckily, Lincoln Financial has a system to show these options side by side in their illustration software. I don't have it on the screen here, but imagine this along with me, and you'll be able to see it when you get that PDF. Two things that you're going to notice are, well, clients will notice the leverage the policy gives to them. Now, why would you want to spend $1 of your own money for $1 of benefit when you could just pay a few cents of your own money for every $1 of benefit? Now, that leverage is going to free up the rest of their funds to be used for something else that they actually enjoy, maybe a new car, a vacation, once we can go on vacations again, that is, I guess. But, I think all of us would rather spend our money on something other than insurance premiums. Now, if we look at taxes, that just compounds the advantages of having one of these policies, and they go into that in these side-by-side illustrations as well. So the report is going to show what would happen to the premium equivalent asset if it was invested in another account. And it's going to show what that would project to grow to over time. It's going to show the taxes that are going to have to come off of that asset either along the way or upon distribution. But by the time the client would need care, this illustration is going to show that they will have double, or it wouldn't surprise me if you see triple the amount of money available to pay for long-term care as opposed to self-funding. So like I said, if they want to self-fund, great. Here's what that looks like. And here's what the same dollars would look like in a policy. Are you sure you still want to do this? Once they see it on paper, I think a lot of your clients are going to change their minds pretty quickly. All right, moving on to the disciplined care funding approach. This comes into play, I think, if the client is considering liquidating a lump sum, some sort of large account to pay for a life-based long-term care policy. So if they're going to pull them out of any account, clients are going to be concerned about, are they pulling it out at the right time? Their returns be higher if they waited a few years. It's kind of like trying to time the market, right? If you do that, you're just courting disaster. But maybe it's better to take the money out for a market loss or an interest rate decline, or maybe you should wait. Well, you never really know, and that's the point. So just like with dollar cost average, when you're putting money into an account, instead of liquidating the one fell swoop to move into a policy, we'll make the case for paying premiums over multiple years, whether 15 years into a policy, or maybe they're purchasing a GUL, or they're going to be paying to age 100 in many cases. Now, the information that Lincoln uses for this one shows money going in over 10 years. But any way you slice and dice it, you're going to be avoiding a potential loss while still catching the best time out there to move that money. All right, I mentioned there's going to be a lot of related ideas, and here's another one of those. This is what Lincoln calls the front-loaded flex pay. So in this case, we're going to mix a couple of these together. We're going to have a single lump sum, but we're also going to pay some ongoing premiums. And this works out very well for clients that have a so maybe they can't fund the single pay product all at once, but they've got money in a savings account, maybe a CD. Of course, we know those are earning almost 0% right now. Maybe the money's in a smaller, policy that they've had forever. Well, you can actually structure one of these products to begin with a lump sum dump in from any of these sources. You'll pay ongoing continuing premiums after that. Now, what that's going to do is lower that ongoing premium as opposed to a plan where they didn't have that lump sum going in. Flexible and affordable because they didn't have a really large lump sum. All right, this idea of accumulating a pool of tax-free LTC funds. It's really another way you can give your clients to pursue what I would call a multi-pay strategy, where they're not paying with a lump sum. They're paying continually over a period of years. Now, this is really meant for pre-retirees and probably people that do not have that large lump to pay or to fund a product. You can actually stretch out, in this case, MoneyGuard product all the way to clients are young enough. Now, stretching out the payments brings that barrier to entry down for most consumers, and it makes it possible for a lot of younger people to get with the policy. And as I mentioned with the previous idea, they don't have to go with a hybrid policy. They could also use this to fund a GUL or a protection-focused IUL, and then they can stretch those premiums out as long as they want. I mean, we can illustrate to age 120 if needed, but whatever it takes to get the premium down to an affordable point so the client can still have quality coverage but be able to afford it. 60-40 premium split. This is an idea that I end up using every year in some case design situations, and something you might want to look at when you're planning with couples. So a lot of times we assume when we're running illustrations that we're going to give a husband and a wife the exact same benefit. Reality is, though, that the cost of care is greater for women than it is for men on average due to longer life expectancies and also longer claims durations. So the way to account for that is in whatever your total premium commitment from the clients happens to be, use 60% of that for the wife and use 40% of that for the husband, and see how much benefit that's going to purchase for both of them. We don't know exactly how much coverage people will ultimately need, but you can use statistics to kind of get there. And this 60-40 strategy is going to help you come closer to optimizing the benefits for each person based on those averages. So you're going to decrease the chances of wasting benefits on one spouse who passes away before they use them all, and you're also going to decrease your chance of coming up short for the other one who might not have enough. Try to optimize it, again, based on the real statistics that are out there. Dealing with couples. And we are now on to the 13th, and I hope a cheer is going up from all of you out there. This is the executive benefit play. And this works, any of you who are dealing with commercial accounts or group accounts, I think this is something you can take and use in. This idea stems from tax code, which makes it possible for any business to offer a bonus to any key employees they choose, in order to fund life insurance premiums. What does that have to do with long-term care? Well, there's no reason we can't use a life policy with a long-term care benefit attached to it. Now, business owners can discriminate with this arrangement And this works especially well if a company has excess retained earnings. They now have a way to reduce those through this process and still provide a pretty valuable benefit to a key employee. Now, if you want to use one of these hybrid policies, we're probably looking at using a 10-pay or a 15-pay plan. This can be used as a golden handcuff too, because the business can now encourage that key employee to stick around for that entire length of time, where the company is going to continue paying the premiums until that policy happens to be paid up. In fact, you might even want to position this as a way to enhance disability benefits for key employees that are getting close to retirement, where disability isn't so much of a concern, but long-term care really is. So those are the 13 strategies, and I actually came across what I would call the 14th strategy, and is off of this piece right here from Lincoln Financial. In fact, I featured this in a webinar I did a month ago, and I really think this could have been strategy number 14. So here's the bonus strategy with this piece from Lincoln. It's really meant for people that are planning on self-insuring, and I know we spoke about that a little bit previously, but this is a real simple way to realize exactly what that's going to cost them if they do choose to self-insure. So this asset identifier, it's meant for you to write down which asset the client would use first in the event that they plan self-insure, right? You want to write down, just ask them, where's the money going to come from when you need care? Is it coming from this annuity over here? Is it coming from your 401k plan, your 403b? Is it coming from this IRA, that CD? All right, so get them to commit to which asset they're going to liquidate, write it down, write the name, the account number, how much is in there. All right, when that asset is exhausted, which asset is going to be next? Write that one down. Okay, when that one's exhausted, which one is next? At some point in time, the pain is just going to be too much for the client. They're going to have an emotional attachment to one of those because maybe they remember where they got those funds from. And they're going to say, okay, stop. Let's look at this insurance-based option again, because we really don't want to spend that money. I wanted to use it for something else, pass it on to the kids, or who knows what. There's a million more fun things to spend money on than buying a life insurance policy. So this could be idea number 14, the asset identifier. And the rest of this goes through some client profiles and some online resources that Lincoln Financial has. And I would encourage you, once you get that PDF, to look at some of those other resources that are in there. There are no passwords required to get to any of this. They've got some fantastic consumer pieces you can use, whether you want to print them and mail them to your clients or send them via social media. They've got everything available there. So would like to thank everybody for joining us for this morning's presentation. And as promised, we are done in a half hour. 13 very quick sales ideas plus one bonus idea there. So if have some cases to discuss in greater detail specifically, feel free to call us. Our number is right up there on the screen, 800-397-9999, or reach out via email. We're here to help you help your clients. At this point in time, I'll go ahead and open it up to questions.